Just wanted to welcome everyone. As you know, most of you know, my name is Sean Flatley. I'm the president of the Irish American Business Chamber Network. I want to thank you for joining us for the 17th installment of our IABCN online webinar series. We're very fortunate to have fantastic member companies part of this, while we're not able to get together physically, but able to provide content, through this time. We have a full schedule of online programs for the summer. Please be sure to check. I'd like to introduce Jim McGoldrick, and I apologize, Jim. You did mention that Matt is with you, and
Matt, do you want me to do that part?
Well, I will put you on to do Matt in just one second.
Sure.
We're going to get started. We are recording today's program, so it'll be available on the Chamber's website as soon as possible. We hope to see you next Wednesday for our next virtual program, Network and Connect, across the pond and across the town. And be sure to check our website, IABCN.org, for details on all upcoming programs. And thank you, and I apologize for that, Jim. If you wouldn't mind, Jim's been a long-time member. I'd like to pass the baton to Jim and have him do the introductions.
Sure. Hello, everybody. Welcome for coming today. As mentioned on the ad, this is a discussion of benefits in the new normal and COVID-19 environment. I'm very fortunate to have one of my business associates and our office expert, Matt Schiff, on the line, and he will be handling the presentation along with me assisting on the disability end. You've known me for several years. It's the one thing I talk about is benefits on the disability end or income protection end for executives. What Matt does, Matt covers all the areas of executive benefit protection and the importance not only of having it, but also in this environment and how to structure it, because the world has changed. As he's joked with me a couple of times, some of what he did, he tweaked something, but a lot of what he was doing kind of fit into this environment without really knowing it was going to happen. He didn't predict the future. He just kind of saw how things were going. So that being said, I'm going to let him get talking and to introduce himself, but this is the areas that we just deal with is how do we assist our executives in doing their benefits and doing their protections and also doing it in light of cash flow issues that are occurring now because of the COVID-19. That's it. So Matt, you're up.
Great lead in, Jim. Thank you for your time this morning, everybody. And anybody who's watching this on a recording, please feel free to look at this and then go to our website afterwards. All of our content, I have about 30 slides, and I'm not going to spend a lot of time on some of them, and then I'll spend 5 or 10 minutes on 2 or 3 slides. And the reason why is some of them have real stories behind them, actual casework, and can give you examples of what business owners have done. So many times in my life over the last 30 years, I've worked with a business owner who said, you know what, I'm out of here in 5 to 7 years. I don't know what I'm going to do about a succession plan, but I know if somebody came along and gave me the keys or gave me a lump sum of money, I'd give them the keys tomorrow because it's just enough and I'm done with it. So the question is, how do we keep our best people, build our business, and in an environment where everybody is really focused on keeping their capital, their working cash on their balance sheet, how can I provide a meaningful benefit that doesn't cost the company money or cash flow today? So what I want to do is I want to walk you through some of the things that we can do. The first thing that I'm going to do is we're in the new normal. Everybody called it the new normal sometime around April. As soon as it happened, our world shut down. The insurance world immediately dramatically changed the day that the economy shut down. So what's the goal when we're trying to implement a program today? Is it going to be a way to enhance a 401k? Is it a way of providing an income? Do I need to have flexibility for funding the benefits today and in the future? When am I going to pay the benefit? Is it going to be a form of ownership? Is it going to be an employer pay program? Is it an employee pay program? And these are all things that are part of a discussion that it doesn't happen usually at the HR level, except when the CFO or the CEO says, hey, look, I'm willing to spend X dollars, see what you can get for those X dollars. Then I'll design any type of plan that you want based upon your metrics and your cash flow. That's the nice thing. Remember, every single one of the plans that Jim and I put together are customized based upon the owner. The owner may be a C Corp, it might be an S Corp, it might be a partnership. Each one of those three scenarios has three different tax structures and three different situations that you have to deal with. And when you sit down with somebody, they say, I want to defer income. Well, if you're an S Corp, you can't defer income. So how can I design it the best way to be tax efficient to the business owner, to provide a meaningful benefit to the non-owner, and also provide transition or other types of benefits that are being built into the plan? When you design these programs, you have to be aware that you might get caught by surprise. There are tax laws that change, there's accounting rules, and oh, by the way, you might have an employee who decides to leave and at the last minute, that's what happens, you get hit in the back. So our story really is that we help the clients establish the objectives, design a benefit program, all customized, implement it with a TPA, accountants, attorneys, get all the documents for you, as well as provide the ongoing administrative support. We are your quarterback. We will work with the accountant. We will work with the attorney. And in fact, I have specimen documents that an attorney can take, immediately write them up, mark them up for the client, and at the same time, charge the client for his time and services. So I'm an added value to both the accountant and the attorney as part of putting this type of program together. If you have a health insurance provider, we work with those health insurance providers to help put everything together in the way of their census, their employees, their benefits, and then Jim would put together the disability add-on benefits, as well as a 401k or a non-qualified plan. What we bring to the table is a lot of disciplines. Between the agency that we're located in the Mass Mutual Eastern Pennsylvania office, as well as running Schiff Benefits Group since 2006, we bring accounting, actuarial, administrative, compensation and benefits, investment and insurance expertise, and then we bring to the table our referrals of attorneys, TPAs, and accountants. Some of the clients over the years have included a number of firms that you probably know the name. Teva Pharmaceuticals. We did a deferred compensation plan for them specifically where they were acquiring a division, a sales division that was not part of their company, that had a overly sizable profit sharing contribution. And I'm saying a 15% profit sharing contribution to their sales department if they made their numbers on an annual basis. Well, when they were brought into the fold in the national company, they lost it. They went from 15 to 5. Well, this is now a non-qualified benefit. It's a discriminatory benefit, discretionary in nature, and given to key employees. 100 employees out of 2,000 is a discriminatory benefit. So that was one of the types of programs that we could put in place for them. Credit union in New Jersey, they had 3 key employees. They were looking for an income. They said, we want to keep the CEO, the CFO, and the COO around until retirement. But we don't have a defined benefit pension plan. In fact, most people who are younger than the age of 50 have no idea what a defined benefit pension is. Basically, as Jim said in the beginning of the intro, he creates income in retirement or streams of income for executives. In this case, Credit Union in New Jersey was offering a benefit equal to a form of salary payable for a period of time at a triggering date of retirement and age 65 for a period of no less than 10 years. Well, whatever that was, they had to fund for that. They didn't expense it until the day that the benefit was due, and therefore it was not a drain on their cash flow today, but something in the future. It's a liability that would reduce the value of the company. Now, I could go through each one of these companies and give you some examples, but I'm going to show you a little bit more as I go through this. So the executive benefit programs that are out there today that you can find are, and there are 6 of them that I looked at in whole. The first one is deferred compensation. Deferred compensation is compensation where the employee is able to defer money at the company level. It's a pre-tax deferral, stays on the balance sheet of the books, becomes a liability, and is not taxed until you actually get constructive receipt of the income at the time that the benefit is paid. Money can be deferred for anything over 13 months up to the age of 65 if you wanted to, or even further. And then the time and form of payment falls under 409A. A supplemental retirement income. That supplemental retirement income is payable for the key employee as an individual and is discretionary in nature based upon when it's funded and how much money will be put together and put aside for the participant and is paid for by the employer. No employee monies are put together, and it could be some type of plan, such as a phantom stock plan or equivalent to ownership. It's an income that'll be paid, broken out over a period of time, whether it's a lump sum or 10 years or 15 years or lifetime, that would be paid from the company to the employee and not taxed until the day that that payment is due. So if you have 10 equal payments, you'd get 10 equal taxable distributions if you were in a C Corp. If you're in a not-for-profit, it's all taxed up front. And I can get into that a little bit later on if there's a question. Supplemental life insurance. As part of these programs, many times supplemental life insurance is an added benefit of these programs. Usually one-time salary, two-time salary, or a formula of that. And usually is done on a guaranteed issue basis. However, it usually takes 10 employees to get guaranteed issue or 5 to get simplified issue. And depending on the structure of the benefit, we can design this such that your CEO, who is uninsurable, who had bypass surgery less than 90 days ago, can get guaranteed insurability. That is one of the benefits of implementing these types of programs. Long-term disability income, Jim's specialty. Works in the IDI, it's individual disability market, and it's usually done on a guaranteed standard issue basis, where the guaranteed standard issue does not become a cost of running the business or to the HR person a headache to be able to bill out and deduct each of the premiums for each of the participants. Mass Mutual, as example, would do that, as well as Guardian. The nice thing is you can get up to just about 70% of your total net after-tax income when you combine both the group benefit and the individual benefit, which most people don't have, and Jim can walk you through that. Long-term care insurance has changed greatly over the last 20 years. There used to be a time when I could implement a program that was paid for by the employer and have it deductible by the employer and have a tax-free benefit by the employee. That's still around. But one of the companies that used to have it was, they would say, I'd pay it for 10 years or to age 65, whichever is longer. And then it was a paid-up policy. Today, you have to buy single premium policies or shortened pay policies in the marketplace and go through full underwriting. Those types of policies on guaranteed issue are no longer around, but long-term care, there's a 70% chance that somebody will go out on claim for 3 months or more during their lifetime. As such, it's a valuable piece of planning for every executive in every company, and every company should think about implementing some sort of supplemental long-term care benefit. And I'll show you why the employer should be paying for it, because I can get all of your money back using what we're doing for these types of programs. And then lastly, survivor income. Survivor income is above and beyond all life insurance, any other types of benefits that you might have. It says to the employee's family, if you die while you're working here, I'll provide an income to your family that's equal to one-time salary for the first year and then 50% of your salary for 4 more years, or a total of 300% of your salary over the next 5 years. Excuse me. The reason why we can do that is we have key man life insurance on the employee, and the key man life insurance is payable to the employer, which would then be paid to the employee if they died prior to retirement and were working for the company at that time. If you leave service, that benefit is left on the table and it's not taxable to you while you're working. That's the nice thing about it. There are different types of companies that are out there. What we're trying to focus on today when we talk to you is we're talking about the small to mid-sized business. You might be in a large industrial company and we can work with you. You might have a bank, of which there were 7,100 banks as little as 2 years ago. Now there's about 5,600 banks in that market. And the healthcare market has totally dramatically changed. And we've worked with a number of institutions around the country over the last 20 years, working with hospitals and medical groups, but there are about 4,000 groups of those. And I would say that the average person that's on this type of call has a unique business that they run personally. They have a handful of employees, usually 15 to 30 employees, and we can do the types of benefits that all of these types of programs are designed for larger companies, but at a small company level without having to bring in a lot of consultants. That's the reason why I put this slide up. Now, a lot of material here. What I want you to understand is On our website, we actually have some forms and articles that allow you to go through the what ifs of benefits that you'd like to implement. There are different types of ways of implementing a benefit program. One is a deductible benefit, and then the other two are non-deductible benefits. If you needed immediate deduction, where I want to put a restriction on it, and I want to keep that employee around forever until they get to retirement, I can put an executive bonus in place, make it a deductible contribution to the employer, and then put an agreement that says if you leave any time prior to retirement, you have to repay any of the taxes that I paid on your benefit that was put in place for you that I got the current deduction. So basically what's happening in an executive bonus plan here is I'm giving a double bonus from the employer to the employee where the employee has no tax consequence in the year that the benefit is paid. It's structured however I want to do it. And it's discretionary every single year that the plan is in place. Funding is based upon the product that you would implement, not so much based upon the company, its metrics, etc. You can design it however you like. The next two types of programs, a non-qualified deferred compensation plan and the non-qualified supplemental executive retirement program, create a liability in the future that is equal to a benefit design. The benefit design in an NQDCP plan can be based upon the metrics of the business. So if I was a manufacturer and I was the manager and we had 360 days of no injuries on the job, I could get a $10,000 bonus put in my account. It's a discretionary bonus, it's a discretionary account, and it's a numerical listing on the balance sheet of the company payable sometime down the road based upon your vesting and when the time and form of payment could be done. The nice thing is this middle piece gives you flexibility to say, you want a benefit that is meaningful? Great, I'll give it to you. 5 years from now, you'll be able to access this cash while you're working for the company. And if you don't take it, you can redefer it. And I'll give you the ability to redefer it for 5 years or until retirement. This means that you can take this money and use it for college education if you want it. Or I can let you cash out part of your ownership in the company as a phantom stock plan if you are vested in the benefits. What's that, Sean? Sean, I can't hear you. He's talking to somebody. But the last piece is a non-qualified supplemental executive retirement plan, and that is the income. It's designed to be a structured benefit that's payable at retirement for a period of time based upon either 1 or 2 lives, and you can do actuarial equivalents for payments. So if you said, okay, I'm going to get a payment of 5 years and I was single life, I could do joint life for the rest of my life and do an actuarial equivalent and keep it for the rest of your life when you reach retirement. It's like the old qualified defined benefit plans, except this is discretionary and discriminatory for 1 or 2, maybe a handful of employees. All of this material that I have on here is up on our website at schiffbenefits.com under articles and forums. But one of the things that you need to understand is based upon each of the different types of programs that are out there, they'll either have an impact on the financials today in cash flow, which is the executive bonus plan, or just an accounting and liability expense until it comes due in the non-qualified deferred comp plan or the supplemental executive retirement plan. Vesting and control is completely discretionary and discriminatory and can be extremely, extremely restrictive. Or if you decide to sell the company, it can immediately change control, vest in the benefit, and the person gets all of it upon that change of control, and it's a great golden parachute. However, in all of the scenarios, these types of programs don't have to be a true expense. I can create an asset on the balance sheet of the company that would recover all of the funding, liability, all of the time value of the money, and all of the net after-tax cost of the benefits and have it recovered to the company. And I'll explain why. As an example, we did a program in a post-COVID environment for an employer that was an S Corp. They had a 401k and they wanted to get rid of their profit sharing plan. The reason why is most of the people weren't participating and they wanted to actually get rid of some of the matching. We said, don't get rid of the matching. We'll get rid of just the profit sharing piece. But in this case, you could have eliminated the safe harbor contributions. You could eliminate your company match and you could reduce your company match cash flow. The biggest problem with this type of scenario is what happens to a key employee, and that might be 5 or 10 employees out of 100, if they're putting in the full contribution of $19,000 into the qualified plan? Well, they would end up with a refund. So what's their alternative? They need to have a pour over. The government requires you to set it up so that if you're getting money back in a future year on income that was earned this year, i.e. a refund from this year, you need to make that the election that, oh, by the way, I'm going to redefer it into the non-qualified plan. What would happen to the employer? Is there any cost to doing this? Well, we implemented the program with the same cash flow that had no material impact in cash flow on the employer. We just redirected the funds, eliminated the company cash flow to the people who weren't participating, actually got key man insurance, and provided an additional savings vehicle for the key employees. In the case of these 6 employees that we have listed here, of which 2 are female, 4 are male, and we have a spread of income all over the place. We said we'd make contributions equal to 10 to 20% of their compensation each and every year for the next 10 to 20 years until they retire. Based upon their compensation, their account balances ended up, and I'm going to move this thing out of here, ended up being $90,000, $38,000, $91,000, $49,000, $147,000 of income based upon their account balances at age 65. In the case of the 59-year-old, what we really wanted to do is have key man insurance on him as part of our group. We were not going to provide an additional retirement benefit because he was part of ownership already and getting pass-through income. And so we were able to carve out his benefit as something totally different. In this case, by using company-owned life insurance, which is a unique financial vehicle, and if you looked at the top 3 banks in the United States, they're capped out at how much life insurance they can own. They own almost 25% of their investment capital is in company-owned life insurance because of the tax efficiency that it gives it. They're the owner, the premium payer, and the beneficiary of the policies. And it creates the surplus to provide the benefits on their balance sheet. The reason why they were using it is they provide supplemental income to their key employees. It provides a key man policy as well. It helped it offset the cost of their supplemental executive retirement programs. It helps fund buy-sell agreements as well as buying back shares of stock on employees that may own part of the company. It helped them recover qualified pension costs. So if you looked at a retirement plan and said I was making a $100,000 contribution each year for the next 20 years, and you had $2 million of costs in a qualified pension, they would buy a $2 million net present value death benefit to help them recover that cost. And then what I mentioned earlier is long-term care is such a great benefit and so vital. I cannot tell you my own experiences of dealing with grandparents who had to be taken care of, who benefited from having long-term care, that the companies actually prepay these policies or are willing to pay the policy even after employee leaves, because the long-term care policy, when it's purchased at the age of 40 or 50, if you're buying it on an annual basis, is a lot cheaper than buying it at age 70. And therefore, the employer says, you know what, I'm paying $500 a month, so it's $6,000 a year for the next 40 years. You know what, $240,000, I'll buy a death benefit, it's all done. Thank you very much. And then lastly, I don't know if anybody has ever thought about selling their company to an ESOP, but there are a number of great articles about how to cash out your business and still hold on to control of it in today's environment. And company-owned life insurance helps you fund the informal obligation of the ESOP that is funded by the bank. And that's where we can help you really get creative in designs. Company-owned life insurance, the reason why it works so well is depending on the type of product that you have in today's environment, you can put in about $400,000 of cash and have about $300,000 of cash value. In the way of a bank, when you put in $400,000, it's over $400,000. It's called a modified endowment. And the difference is that if you go to take the money out, it's taxable. In most scenarios in a company-owned life insurance world or a company-owned policy where it's multiple years of payments, you can access the cash tax-free. You get a tax-free death benefit, and the money grows tax-deferred. As long as you keep the policy in force for the remainder of the life of the individual, you should always receive that death benefit instead of a taxable scenario. And the reason why a CFO and many of the banks or corporations implement company-owned life insurance as a funding tool is that they have an impact on their company earnings that far exceeds an 18 to 22% return on capital. That's company earnings. That is what we call impact on company earnings. In this case, a standard whole life policy, which is what this is showing to be, would be 57% rate of return on your impact on capital on a 10-year payment policy. It was straight out of the book. It's as simple as it gets. And it says to me as the employer, I know my risks. I know my cash flow. I know what the downside is. I know what the upside is. And I've basically taken all market risk out. I've said I've funded this over 10 years. I have flexibility. If I need to catch up, if I need to short pay it, I've got the ability to do that. And that's the reason why corporations do this. They look at the benefit. They say, what am I trying to accomplish? And then they say, let me sink money somewhere on a cash flow basis that's tax efficient. So when we put it all together, we'll provide specimen documents to your attorneys. We'll provide all the accounting entries. We'll give you an online TPA, an employer and an employee portal. If it's integrated with your qualified plan, you'll see it all in one place. We'll provide you online enrollment if that's what you need, or paper enrollment. Sometimes you want to sit down and say, this is the type of benefit you're getting, and get an employment contract as part of that. It happens all the time with our employees. We'll provide policy value reporting, accounting, tax reporting, link to your payroll, and provide communications to your employees. The nice thing is it's a process. Nothing that we do is an off-the-shelf, here we're going to take a square box, put you into it because you're a round hole, and it's junky. It doesn't work that way. We have to customize everything that we're doing. We're going to give you some sample questionnaires. Do you need a current deduction? Is it an employee match? Is it an employee income? How would you like this structured? Do you need a current deduction? Do you want it to look, smell, and feel like ownership? Is it a buyout agreement? Do you need to have insurance? You know, are you maxing out your 401k? Would you like to be able to provide a discretionary contribution that looks, smells, and feels like a 401k? These are standard questions that we go through. Again, a lot to think about in a post-COVID environment where you're going, I can't afford any cash flow. So if you can't afford cash flow, let's implement a benefit structure, a plan document that says, if you stay here until a future date, the benefit would be paid. It's a liability, but the thing here is, if the person doesn't perform, the company doesn't increase the liability. If you're giving up a stock appreciation right type plan, the stock is worth $10 today and the company doesn't grow, you have no liability. That's the nice thing. And it's only a framework for the benefit going forward. My expertise over the last 30 years, I've been introduced to accounting, systems, home offices, all types of businesses, and been involved in a lot of different boards. We've gotten a lot of experience working with small companies, mid-sized companies, large companies, every different types of structure. So at this time, what I'd like to do is open it up to any questions about a specific program that might fit for your company and see if there's any specific questions. I can give samples, I can go on the web, but I think that if you have some questions, I think that's probably better to get into interaction here, Jim, and you kind of host that, okay?
Absolutely, yeah. Yes, as I said, you saw what Matt's discussing on the benefits end, and I kind of dovetail off of that just on the income side, income protection side. But the main stress point is people are very cash flow conscious right now as the world has changed, as we try to, hopefully get back to what business used to be. But even that will be different no matter how we slice this out. So yeah, just open it up for questions to Matt or myself for the different concepts here that were thrown out where they may be applicable.
Jim and Matt, I have a question about key man insurance. Given the unusual circumstances of 2020, can you give us a sense of how that looks going forward? I mean, just as a case study, I'll give you an example. My firm upped the key man insurance in terms of the policy amounts or the benefit amounts. Early, kind of locked it in earlier this year before all of this started. For most of the middle part of the firm, the late 30s to early 50s age range. Is that market changing significantly with the COVID situation? In other words, are rates going up? Is there a window that's closing for firms to do that at I'll call it a reasonable cost?
Jim, do you want to take it or should I?
I'll do the DI part, man, and I'll let you handle the life. On the disability end, there has been no change, Kevin. There's been no change to whether it's regular medical underwriting, other than medical underwriting obviously has been gotten a little bit stricter in some areas, especially on travel. But as regards to the product, the cost and the structure, and then the guaranteed issue, there's been no change. No, I haven't seen anything on our end that has drastically changed.
On the life side, however, there has been a change. On March 15th, we were in the process of doing a very sizable bank-owned life insurance deal. And literally, actually, we were doing two of them as of March 15th, trying to get everything done by the end of the quarter. And literally every single insurance carrier that was in the guaranteed issue market hiccuped based upon the rates that were going on. So they basically pulled their product for about 2 weeks and then they came back. So if you were in the middle of doing something, you could finish it up, but you couldn't start anything new. What I've seen dramatically is that the permanent products that are guaranteed issue, at least in the institutional world, the rates of return have gone down. The rates on the insurance products on January 1st, because of the new mortality tables, actually went up on the COLI policies. On the individual policies, they've actually gone down from an underwriting standpoint, but they've become more restrictive. So that's saying your cost has gone down, but the chance of you qualifying is less on the individual side. With regards to a group universal life product, which is something like Focus 10, which Emeritus puts out, it's a group term policy that would go until age 65 possibly. Those rates are actually ticking up just a little bit on a guaranteed issue basis as a group. But if you got in January, that would be a great thing. You could get up to $3 million of coverage, depending on the number of lives that you have in the firm, just with a stroke of a pen. What I do know is that we've worked with an oncology group down in Florida where I have over 600 doctors insured in a group universal life policy. The nice thing about that is it's basically Susie Orman's buy term and invest the difference. So you're paying for term insurance rates. The employer can pay the term portion. The employee or doc can pay the difference in the way of cash value and keep that policy in force for life based upon the GPA account or an investment account. That nice thing about it is it's group term life that's portable, unlike normal group term. So that's something that may be of interest to firms that are out there that are looking to supplement their life insurance above and beyond the group world. But in what they call company-owned life insurance, it's just that the market rates have changed and mortality rates changed on January, but it has not been impacted so much by COVID. Physical underwriting has been. So that's a long-winded answer, Kevin.
It's a very informative one.
Thank you. We live this every day. That's the thing. I have clients that I have a client who does distribution of mail order goods, and they're booming like crazy, just like Amazon. And the two brothers, one is totally uninsurable, or was uninsurable until about 2 years ago, and we were buying group policies or key man policies at companies where it was all guaranteed issue. And he's worth probably 30 or 40 million dollars in the company, because the company is probably worth 70 or 80 million between he and his brother. Mm-hmm. He had prostate cancer, Gleason score of 8, 9. You know, his wife was crying to me about how is he going to survive, and he's now 9 years removed from it in great health. And insurance carriers go, well, wait a second, he's uninsurable because of his Gleason score. And I'm like, no, he went to Sloan Kettering. He had one of the best doctors in the world. You know, he stays up on his treatments. Those are the type of underwriting scenarios that's where we're really good. We get really, really creative with life insurance. If the company can fund the benefit and all we have to do is create a sinking fund, then we can use the business as a pass-through to provide the benefits to somebody who's uninsurable. Yep. You hear what I just said there? Let's say I take Jim, Kevin, and myself. I'm uninsurable. If I insure Jim and Kevin at the company level and I create an asset that has tax efficiency, I can provide myself all of the benefits from the policy that are owned by or that are insuring Jim and Kevin, if it's owned by the company and paid for by the company.
I want to dovetail off what Matt just said, off somebody said at the beginning of the presentation. If you're not seeing it today, I would say within the next 24 months, you're going to see it in overdrive, because Matt and I have seen several articles about people succession planning, getting out of their businesses. Okay. One of the issues that comes off dovetails off what Matt's saying. If insurance is part of the solution, but the person's uninsurable, if we get into a business arrangement, it's not a personal arrangement, and we start balancing it out, there's ways to do that and assist with the succession planning overall. So it's the one thing that's got my antenna up, because I know people always say, I'm going to hang on, or I'm going to keep doing this for a little while longer, blah, blah, blah. I'm not ready to do it. I can't tell you how many people I've talked to when I clear this hurdle, whether that's in the next 6, 12, 18 months, the next thing I'm doing, what's A1 on the priority list is getting out. Okay. Efficiently, correctly, tax it, everything possibly, but they're done. They're exhausted, because as the one article I read, and Matt laughed when I showed him this, they broke down the age groups, the boomers, the Gen X's, the millennials, how they're going to react. The Gen X's, they hit the nail on the head. And that's probably the sweet spot of people getting out of businesses. They've been on the front lines for all 4 wars, the .com, 9/11, 2008, and now this. Okay, they're not going to quit until this is fixed and their businesses are functioning and everything's going well. But once this is over, that is going to be one of their primary goals of saying, listen, I've built a young team. I have a group of people who can take this over. Or I've picked my successor. How do I get out? How do I make this efficient?
And see, if I want to get out and I want to still control the company, you can sell part of the company to an ESOP, which is a tax efficient way of doing it if you're large enough and you have enough cash flow. It's a great way of monetizing the business, doing a transition, and providing a meaningful benefit to the management team that's going to stay around. Now, Jim and I also have the benefit of working with Mass Mutual, which has an incredible business valuation system that we can come in and give you 3 different valuations on the business. We take EBITDA, we take times earnings, and the balance sheet. And if you want us to do this, we can help you sell your business along the way by getting you the valuations that you need, not at a huge cost, which is a nice thing. And if you're selling the business, I can tell you this, I've had a number of clients sell their business. Once they do it, they're going, okay, this is the largest amount of money that I'm ever going to have. Who do I have who can manage this? Well, I know XYZ person. Jim and I don't manage money per se, but what we do is we get money managers, and we are the quarterbacks behind this and help them set up their trusts, their estates, a full financial, excuse me, I'm just getting over something, a full financial plan. And what I really like about what we've done over the last 20 years at Schiff Benefits is we create income in retirement. There's a guy named Tom Hegna who, if you get a chance to read or watch any of his YouTube videos, I think you'll be really impressed with what he shares in the way of knowledge. He and Ed Slott talk about how do you maximize your income in retirement and take away all of the risks in the market. And Tom says it's not about asset allocation, it's product diversification. You want a product to provide the benefits to you, take out all the risks and provide guarantees. And he says that in his world, guarantees don't cost you anything because he's saying it's just like your Social Security benefit. You don't think about what the cost is. You're just saying, I'm getting 5% of my income every single year because Social Security pays me 5% of my income. That's the way you should be looking at your income in the future. You have a paycheck and a playcheck because, as he says, when you design these types of programs, there are 3 stages of retirement. You have your go-go years, your slow-go years, and your no-go years. Your go-go years, you want to have a paycheck so you can go around the world on the cruise, play golf every day, and you want to see everything that you didn't get to see while you were working. You have your slow-go years, you're starting to slow down, the grandkids come along. Yeah, you go on the trips, but it's not as much fun. And then you got your no-go years. That's when your family's taking care of you in your house. You're going, man, I really hate to be a burden, but now here's some of the largest costs you're going to have because you have a long-term care need. So you need to be prepared for each one of those things. And if you retire at age 65, which is becoming more and more rare these days, if both of you, if you're married and retiring, the chance of one of you reaching age 90 is better than 50%. So you better plan as if you're going to live into your 90s. And as a business, I can provide that supplemental income that would either make up the difference between age 65 and 71 when you start to take your qualified money, or provide the supplemental income above your qualified plan and your Social Security to provide 70 to 80% of your income in retirement, which is the average that people need when they get to retirement over their normal pre-retirement income. With that, I've gotten to the end of basically what I have to say. We've covered a lot of material here. What I would recommend is going to schiffbenefits.com. I will come down to our slide at the end here. It is truly one of the best resources for non-qualified deferred compensation information, at least from what I've been told from other people in the industry. There are articles, there are videos, there are questionnaires. You also, if you wanted to apply for a policy from Mass Mutual, there's a quote engine right there that will give you the ability to quote yourself some insurance if you wanted to. So you have everything on there that you might need for education. And then I say, give Jim a call or myself a call if you have any questions about this new normal environment in the business world.
Yeah. The one thing, and when Matt was talking about the different, no-go, slow-go, living to 95, I always think the Mickey Mantle rule now applies to everybody, which is if I knew I was going to live this long, I would have taken better care of myself. I think everybody, the scariest thing I think I've seen, I think Matt will agree with this over the last, definitely the last 20 years, people are living way longer than they even ever expected in their mindset. So if you have people, and most of those people have pensions, which you're not going to see in our generation, you know, that's a fading thing. If you're seeing people live, 80s, 90s, living to 100 is not going to be a stretch anymore, not with the medical advances. And I was talking to Matt yesterday. My brother-in-law works for J&J. He's on the COVID drug team in producing it. But one of the things he told me a couple of weeks ago when we talked, he says, when this is over, when the COVID's over, when they have treatment for it, he said, the medical advances you're going to see in the next 5 years are going to be stuff that you thought you wouldn't see for 10 to 20 years, okay? Whether it be kidney disease, cancer, diabetes, brain, heart issues, circulatory issues, anything. He says, we are going, like, to give you an example, we're all doing a Zoom here. Matt and I, our whole business has changed. We did 5 years of technology advancements in about 3 months. Same concept is going to happen with that. So if there is going to be stuff that you're going to live through that's going to be chronic per se, that means you're also going to need money for a longer period of time. So like I said, when Matt talks about these concepts of using assets in this post-COVID environment, not because we're worried about income, but we need ways of structuring this. But the biggest structure that we need is to think that you could be retired, you could need benefits for
30 years.
for double the time you originally planned. I think that's a safe number.
30 years is a safe number for benefits. You're going to have benefits for over half of your lifetime that you're not going to be working. And most people go, well, you know, they remember the ING commercials, which ING is no longer ING, it's now Voya. But Voya says, what's my number? Well, 4% rule doesn't hold true anymore. You can't assume you're going to take 4% out of your plan and still make it through retirement. If you had a hiccup like you did this year, where the market went down in a flash drop and a flash up market, and you had to take money right at the time the market went down, how much do you have to make up in the way of a rate of return that you took the money out at the wrong time? Your sequence of returns can kill your ability to survive retirement if you're taking money out of the market at the wrong moment.
Mm-hmm.
And that is something that most people don't understand. So,
and something just to parallel off that, when we're talking about the money saving, this is on the income protection end. If you're not working or you're not working for your company, there's nothing being put away for you. We have a way to protect the deposits going, that your savings continue throughout. Okay. Not only are you getting income coming in your pocket to pay for everything, but you also have income or assets going towards your retirement if you're unable to work. So it's a constant issue because of the biggest risk. And I love that Matt brought up Tom Hegna. Tom Hegna, besides sequence of return, preaches about longevity risk in every presentation. And that to me is the greatest, more than the market risk today, is the length of time you could live. And nobody's going back to work in their late 80s, early 90s. That's just not happening. Okay. So we have to view that we're going to, live a long period of time. And I always say this all the time, and I know Matt says this a little bit differently. I always say, I'm not trying to make your kids rich. Get that out of your head. That is not my job. My job is to make sure that we have you structured with benefits, that everything works works out for you the way you want it to work out. If there's money left over at the end of the day, so be it. Okay. But that's not the primary goal.
Jim, this is the way I say it. Okay. You want your first check that bounces the day after you die.
Yes. That's it. Is there anybody other questions? Anybody else?
I want to thank everybody for your time today.
Yeah.
If you have any questions, feel free to reach out to us. And we're also on the YouTube channel. You can find us there on the website. There's a lot of material. Look forward to seeing you and hearing from you. And again, thank you for your time.
And me too. A lot of you, most of you I know, I've known you for several years. I'm really looking forward to we're back to a normal meeting program, whether for breakfast or cocktails or whatever the case may be. But I'm hoping that everybody is doing okay, your business are okay, that you personally, health-wise, are doing okay. And we will make it through this. It's going to end at some point. And when it does, I think not only will our economy be stronger, but I think this group is going to be stronger. I've really appreciated everything that Alana has done and Sean has done through this insanity over the last several months. And I know it'll end at some point. The problem is nobody can see it right now, but it will eventually. But I want to thank everybody who was on today.
Yeah. Kevin, I think you and I met before as well, just so you know. I've lived in Philadelphia 25 years, but I think we've met at some of the meetings.
We have, Matt. It's good to see you again.
Nice
even
to
if
see you.
only virtually. And just to segue off of what Jim said, thank you both for putting this together. As you know, Jim in particular, we are a member-driven organization, and it's consistent support from members in the form of just membership dues, attending events, putting on events like this is particularly important right now because it does help us stay connected. We may not be able to do the big 600 person events, but sometimes events like this where you have 10, 12, 15 people can actually be far more fruitful on a long-term basis in terms of conveying a very distinct message and giving other members a very defined idea of what it is that you do, so that they have that in mind when they are speaking with other people moving forward. And we found that over the years, that is by far the most significant benefit to this type of event.
Well, you asked a great question, though. I mean, from an insurance perspective, just the industry standpoint, what's going on? One of the things I've had is I've had questions straightforward. Can I stop doing my matching contributions in my qualified plan, and what are the impacts of that? You can do it. You have to give your participants 30 days notice before you can do that. But there are so many implications to changing your qualified plan that this type of program, that what we're talking about, can be done at the same time, that would have no material impact and in fact reduce the cash flow of the company, because now it's only employee money that's being put in, and I can set it up so that there's no tax consequence to the employer and no cash flow impact to the employer behind the scenes. It's almost tax neutral and cash flow neutral by doing that change. But so many people are afraid of doing that because they go, oh, I got to change the plan, I got to do all this stuff. That's the reason why you have a qualified and a non-qualified plan. The government wanted to make sure that everybody's taken care of properly on a proportional basis. So this is the forum to share this type of knowledge more than anything else. Whether they do anything, they're going to find out, hey, this is what we can and can't do in today's environment. This is what other employers are doing. This is what the big boys are doing. And this is what we can do. So it makes a lot of sense.
Tom, did you have a question?
No, it's just very impressive, the amount of knowledge. I really appreciate it.
Oh, well, thank you, Tom.
I agree. Well, thank you, Jim and Matt, again. As I said, just wonderful to have this type of content from members, and I'd ask everyone on the call to keep it in mind as you're talking to your other business contacts for purposes of getting them to the people who know what they're talking about, like Jim and Matt. As Sean said, this has been a very successful series of events. We have a few coming up to keep in mind. One that's a little different than most next week is our Network and Connect across the pond and across town. We'll have Bill McLaughlin presenting on networking. And for those, I'm sure all of you know Bill, but just in case any of you don't, he may be the best networker ever. Certainly the best that I've met. And I hope most of you can tune in and learn something because Bill's an impressive guy and obviously is the moving force behind this organization. In the meantime, and just going forward generally, please check our website. The content from this program, from all of the other programs we've done, is up there. Please keep it in mind as a resource to send to folks in your company and outside of it who may have a use for this type of I'll call it expert information. And in the meantime, please stay safe, and we look forward to seeing you on more virtual calls and eventually seeing you all in person at some point in the near future.
Thank you.
Thank you.
Thank you very much.
Take care, everyone.
Take care.
Bye-bye.